Hello and welcome to another thrilling accounting video. Today, ACCN3 June 2012, specifically task 3, which is incomplete records. So the trick with incomplete records is always to just do your workings and then they'll just ask you to put it into an income statement or balance sheet. With this question, they just want a balance sheet for 28 marks. It's a lot of marks, but the majority of that is in your workings, so if you get your workings right, you're bound to get the balance sheet right. So, here is the information. I'm given a bank account, some details of some brought downs at the start of the year. We want the balance sheet at the end of April 2012. These are the end of April 2011, so the start of the year. They've given me the bank for the start of the year to the end of the year, so that's complete. They've given me partially completed income statement, so I have to fill the gaps in, find out what this net profit / loss is, and then I can put that into the balance sheet and we can find the balance. So to start off with, we might as well do some working out from the additional information given to us. So I'm going to combine working 1 and working 3. So there were no additions or disposals of non-current fixed assets during the year, so we've not bought any or sold any. We've kept the non-current / fixed assets we've had throughout the year, and depreciation on these assets I've just spoken about is provided at 25% using the reducing balance method. Okay, so how are we going to do this? Well, on this sheet I have my value of the the assets at the start of the year. So I just need to find out what the value they are at the end of the year, which will give me my net book value, which will go in the balance sheet, and the depreciation I can put in my income statement. So 25% reducing balance. So what I can work out is the charge for the year. And this essentially is just going to go in my income statement. This is just the depreciation figure. So it's reducing balance, so it's just going to be 72,600 times by 0.25, so just 25%. So that depreciation figure is going to be 18,150. Okay, so now what we can do is just work out what that net book value is. So that's going to go in my balance sheet. So that's just simply the value at the start of the year minus this depreciation which has occurred to the asset during the year, which comes to 54,450. Okay, so I've got my depreciation expense for the income statement. I've now got the new net book value, which will go into my non-current assets section in my balance sheet. So what I'm going to do now, I think, is go on to working 4. This will help with the income statement. So all sales achieved a 40% gross profit margin. So what a good idea is to sketch out a equation which sort of makes sense of what that says. So sales times by 0.4, so 40%, gives me my gross profit. That's what that sentence is saying in point 4. So we can work out the gross profit without even needing to work out the closing inventory. We can just skip that in a sense, because we know that 40% of these sales gives us our gross profit regardless of what that closing inventory is, and we know what the sales are. It's 87,840. So what I'm going to do is just do 87,840 times by 0.4 to give me my gross profit of 35,136. So that's that. So just in brackets, that's my gross profit. That's simple. So I said we can work out this gross profit without working out the closing inventory, but we still need this closing inventory for the balance sheet. It's going to be our inventory figure in our current assets, isn't it? It's an asset to us. We can sell it on to make cash. So what I'm going to do here is basically do the revenue minus cost of sales formula, well, the equation, and then I can fill in the gap for the closing inventory because I know what the gross profit is now. So what this is basically sales minus my opening inventory. I'm just going to abbreviate that. minus my purchases. Now, we take away our closing inventory away from our cost of sales. So that's being added on here. So that's closing inventory. And that's just going to give me my gross profit. That's the formula that we work out, not the formula, but in a sense, this is how we work out gross profit. But with an income statement, it's just a list. I've just done it in one line. So, just a different way of presenting it in a way. So this is 87,840 again. I'm just going to lift these figures out of the income statement. So 8570. Purchases 52490. Add, I'll just put CI. We don't know what that is yet, but we do know what our gross profit is. 35,136 worked out previously. So with a little bit of rearranging, you just need to take away that from that side, and then just find out what the closing inventory is basically. You can do it on your calculator. So closing inventory will give me my 8356. So that'll go in my balance sheet. We don't need to do an income statement with this question, so working that out does not mean we make a completely new income statement with this filled in. They only want a balance sheet, so you're only getting marks for a balance sheet and the workings in a sense. So with this info, I can now try and work out my net profit slash loss, depending on what it is. So how do we calculate net profit? Well, net profit slash loss. Well, it's essentially just gross profit minus your expenses. Just the bottom half of your income statement. Gross profit minus all these here gives us our net profit slash loss. So what is our gross profit? Well, sorry, what is our, well, yes, in a sense, what is our gross profit? It's 35,136. What I'm going to do is take away all the expenses. So I'll just bracket them so we know that they're all clumped together. So 3,980 is the telephone. The rent was 14,100. 5,680 for the general expenses, and I worked out the depreciation, this question mark, it's just 18,150. So we've got all the expenses, got the gross profit. So this one states 35,136. Take away all the expenses, we get negative 6,774. This represents a net loss. No profit, just loss. So our expenses, our outflows outweigh our incomes in a sense. So we've dealt with all that. We've dealt with the income statement in a way, but there's a few things we need to work with and fix. Well, not in a sense fix, but work out and find a solution to. So we were given rent prepaid, expenses. So these things you have to assume you need to fix. So I'll go through that. I'll just do one now. So trade receivables. So we're going to draw it from T accounts, which I've already done. I don't want the video to be too long and boring. It's boring enough. So trade receivables, brought down was 7140. It's an asset, a trade receivable. So brought down is on the debit. So what you'll notice here, which is quite vital, there were no cash sales or cash purchases. So all sales are on credit. So these sales here, this 87840, represent a increase in trade receivables. Every sale is on credit, and every sale on credit will go to a trade receivable, won't it? They owe us money because they are buying goods off us on credit. So we've increased the trade receivables, but how do they decrease? Well, it's payment we receive, and the bank account helps here. Receipts from trade receivables. So people who owed us money have paid us back. They no longer owe us money. We need to decrease our assets, don't we? They're no longer an asset anymore if they've paid us, haven't they? So we're just going to put receipts. You can equally enough put bank actually there. I'm just going to put receipts just for presentation and understanding. So This side is obviously the bigger side, the debit side. So 94,980. It always will be bigger if you notice, because trade receivable is always an asset. It's always people owing you money. It can be naught. No one can owe you money. But if you owe someone else money, that's just a trade payable or a creditor, isn't it? So the brought down will always be on the debit of a trade receivable. So the total is going to be the same on both sides. So the carry down I've worked out as being 9280. So that'll be the value that goes in the balance sheet, which we're going to make later on. So trade creditors. So it's just the same principle basically, but sort of like in reverse, because these are liabilities now. So brought downs on the credit, they're a liability. 4285. I've just lifted that from here. So as that point 2 said earlier, all purchases are on credit. So these purchases here are going to increase our trade creditors. So that's 52490. Now, the credit of our bank, that's money leaving our bank. Payments to trade payables, creditors, 51420. So I'll just put payments, the opposite of receipts, and that's 51420. So same principle with the trade receivables. The brought down's always going to be on the credit of trade creditors, because someone's always going to owe us money or no one owes us money. Sorry, that's completely wrong. We always owe someone else money, or we don't owe any money. It's never going to be on the other side. So 56775. Same on this side. So the carry down I've worked out to be 5355. So that's our debtors and creditors sorted with. Now we can work out these two expenses that have either been prepaid or accrued. So we'll do the rent first, the prepayment. So prepayment, we paid in advance, it's an asset, so the brought down is going to be on the debit, and the brought down debit is 1,200. Now, so rent here, 14,400. So we can just lift that and put it into the debit of our rent account, can't we? So I can just put bank here, because that's the title of the T account it's coming out of. So that's 14,400. And what is the other figure here, before we put the carry down here, is the income statement figure, which is 14,100. So income statement 14,100. So this side comes to 15,600. Let's just lift all this up so we can see what we're doing. So this side will also come to 15,600. Carry down, still an asset. Remember, it's still an asset now, because this carry down in the next financial year will become a brought down for next year. So it's still a prepaid expense, still a current asset. So we can just do the same thing now with this telephone expense. So telephone, accrued expense is a liability, so brought down on the credit in the amount of 325. So it's just the same principle now with the bank and the income statement figures. So we paid 3,900. It's going in the debit of our expense account because it's gone into the credit of our bank account. So you got a debit and a credit for each transaction. It must be in the credit of bank because money's in the bank account, because the money's left the bank account. All money leaves on the credit in the bank account. So that becomes 3,900. Now just the income statement figure again, which was 3,980. So once again, this side is bigger, 4,305. 4,305. So the carry down still will be a liability. the next year is 405. So with all this information, hopefully we can now make a balance sheet. Also, if we had a brought down on this side, telephone, and then it became a carry down on the same side, say we paid a massive amount compared to what the income statement was, you can have a brought down and a carry down on the same side. You just have a brought down there, carried down here, then it'll become a brought down in next year, so it'll just become a current asset, it'll become a prepaid expense. So in the space of a year, we've gone from an accrued expense to a prepaid expense. So that's how it works basically. So it's just a matter of adding numbers up and seeing which side is higher, which side is lower, which side requires the carried down because it's lower. So now what I can do is make the balance sheet. So I've already written a bit of it out. Title, when you see the includes 2 marks for quality of presentation, you should probably make sure you do a title, so that's probably going to be worth a mark or 2. And just having a nice layout is always advised or recommended. So, non-current assets, it didn't specify any certain assets, it just said non-current assets in the information. So 54,450 is what I'm going to lift up. 54,450. I'm just going to underline it on top just to show it's the only non-current asset we have. So current assets, what current assets do we have? Well, I've just amended the trade receivables. So let's just put that in there. We have the closing inventory, which calculated there. And finally, we still have that prepayment for the rent. So, prepayment. So, trade receivables, carried down 9,280. Closing inventory is 8,356. And the prepayment, 1,500. So the prepayments actually increased over the year by £300. And that brings my current assets up to 19,136. So, current liabilities. So, we had trade receivables in the current assets. We've got trade creditors, trade payables, whatever you want to call them. I think both are fine. We've still got this accrual going on with the telephone, which has increased by £80. And finally, bank. What do you notice about the bank? This sort of it's sort of same as what I said with the prepayment and the accrual here, where it can be on the same side, the brought down and the carried down. So if you have the brought down here, that's good. That's we have money, but however we've got the carried down on the same side as the brought down. So you think about it, in the next year, the brought down is going to be here, 340, isn't it? Carried down goes over to the other side for the next year. That's bad. That's in the credit, isn't it? That's an overdraft. So we've overdrawn, so we owe the bank, don't we? So now our bank's gone from being a current asset at the start of the year to becoming a current liability at the end of the year. So bank overdraft. So trade payables, creditors, 5,355. The accrual is 405, and the bank overdraft I just highlighted became 2,340. So that brings all my liabilities to 8,100, and I say that because there's no non-current liabilities, there's no bank loans, mortgages, debentures. My net assets, that's simply all my assets, take away all my liabilities. Different from net current assets. Net current assets are just current assets minus current liabilities. So this just includes the non-current liability assets. Sorry. So that comes to 6,5,486. So now what can we do? We need to balance this now, don't we? So I'm going to put my drawings in, which are 14,590. 14,590, which I will take away. And we made a net loss, didn't we? we made a net loss of 6774. However, there's no capital down as much as you want. There's no capital figure given. And one way to calculate capital figure is to do the assets minus the liabilities at the start of the year. So I'll show you what I mean here. So what you want is your opening capital is what we want. So opening capital. So this is equal to my assets minus my liabilities. And this is at the start of the year, mind you. So start of the year. So we're not interested in these carry downs, but just the original values I was given at the start, like these 4285, 7140, 72,600. That's what we're interested in. So basically I'm going to add up all my assets. So the 72,600 as I just mentioned, plus the 7140 just below it, plus 1,200, that's the prepaid expense, 1,950, that's the bank at the start of the year. We're not overdrawn at the start of the year, we have money in the bank at the start of the year. And the stock, that'll be the opening stock in the income statement. I'm going to take away my two liabilities, which are 4285, which is trade payables, and the accrued telephone expense. So if you add all your assets up, that's going to come to 1991 460, and then my liabilities come to 4160. So my opening capital is actually 86850. Okay, so now that figure is just going to get put into the balance sheet. We've found the capital figure, so 86850. So where is my calculator? Hopefully this comes to the same figure as the net assets, so 86850 minus 14590 minus 6774, 65486, that's just the number we needed. And that's it. That is all the working's done and the balance sheet balanced. That's it, yes. ACCN3, June 2012, task free, incomplete records. Thanks for watching. Any questions, please email me. I'll make sure I put the email in the description. But anyway, thanks for watching, and I'll see you guys later.